Friends have been asking me why the price of bonds goes down as interest rates rise. Just to give you the context for this question, Silicon Valley Bank is now destitute, and the reason why is they bought mortgage-backed securities, let's just call them bonds, which is essentially the same thing for this purpose, and they bought them at very low interest rates. So for 10 years, because they got 10-year maturations, they are locked in to a fixed interest rate. Let's call it 2%. Now, as the rate of interest rises up to 5%, the amount that any investor could get for putting their money into a new bond and parking it there for 10 years is far exceeds the 2% that Silicon Valley has. So therefore, the contract that they have is worth far less than when they purchased it. Yes, if you ride it out, you will receive all the interest plus the original amount invested back to you. But if you were to try to sell it on the open market, hey, if I can get 5% and you're trying to sell me something that's offering only 2%, well, I've got to drop the price down in order to take on this debt obligation. So what I'm willing to pay you is far less than what you purchased it for. And when Silicon Valley Bank had to liquidate its holdings of bonds because people realized that the assets of the bank were worth far less because of the rise in interest rates, which made the bonds that they invested in worth far less, and there was a run on the bank they had to liquidate, and now they don't have the money to pay because of improper risk management that was brought about. Apparently, the person was a diversity hire that was in charge of risk. So there you have it. Silicon Valley Bank, get woke, go broke. You have somebody who's obviously more interested in promoting diversity, inclusion, and equity outcomes versus managing the risk that he, whoever was hired to do at the bank. That doesn't mean that other people won't screw up, but when you show me diversity hires, I'm going to question whether or not they're competent. And just that's the background for Silicon Valley Bank and why it's going down. Is because, once again, they bought longer duration bonds that have gone down in price, and they were forced to liquidate them because of mismanagement, because of lack of risk assessment. That's the backstory for Silicon Valley Bank. Hope that helped. Leave a comment, let me know if it did. Thumb up the video, subscribe. Peace.